In this series, we speak with core contributors within crypto and gain insights into their day-to-day operations. In this episode, I'm joined by Pacman, who is a founder of Blur, the NFT marketplace for pro traders. Blur launched in October 2022 and quickly established itself as the market leader in terms of volume in the space. In this episode with Pacman, we discuss what Blur is, who's building it, Blur's economic model and approach to future monetization, growth drivers, creator royalties, the Blur airdrop, and more. Hey Pacman, welcome to 15-Minute Fundamentals. I've really been looking forward to this one.
Thanks for having me.
Now, before we get into any of the details, it would be great if you can just give a quick intro to Blur and the team behind it.
Yeah, totally. Just for some quick context on myself, I'm one of the founders of Blur. My background's originally in engineering, so I got my start as an engineer in Silicon Valley around 8 years ago. And after doing that for a year, I started my first business back in 2016. We went through Y Combinator in their Winter 16 batch. Did that for about a year and then ended up going to study at MIT, studied molecular computer science there. And I met Galaga, my co-founder. We basically immediately hit it off and started working on projects together. From MIT, we started our first business together back in 2018. We ran that business for about 3 years and we sold it at the end of 2021. And we started working on Blur immediately afterwards. And the reason why is because in 2021, I had personally gotten really into NFTs, basically just fell in love with the trading aspect of it. But I was very frustrated with the existing infrastructure. All the existing marketplaces were quite slow and clunky. They're going down all the time and they weren't really built for traders or like high volume users in mind. So I really wanted something that was better for the market. So we set out to build Blur as effectively an NFT marketplace for pro traders. We started up in January. We raised an $11 million seed round from Paradigm, built up a team of 10, were 7 engineers, a designer, a chief of staff, and myself. Our engineers previously worked in trading and systems in the past. So one's from Citadel, one's from Five Rings Capital, which is a trading firm, and others from Twitch. Our smart contract engineer was previously working with Starkware and MakerDAO, and our designer was previously in fintech at Brex and Square. So with that team, we've been building for the last 342 days. So today's day 342 for us. And as you know, we launched back in October. We're about 3 months in, doing around like 20 million in trading volume every day now, and also the number one marketplace aggregator. So it's been an incredible journey, but there's a lot more that we're working to build. Hopefully that kind of gives some context on what Blur is.
It sure did. Thank you for the comprehensive overview there. Now, you spoke about your frustration with parts of existing NFT infrastructure. I'd love to hear what the main innovations are that you wanted to introduce with Blur compared to what's already out there.
The easiest way to understand Blur is if you look at how the token market progressed and the infrastructure and the token trading market. So, we kind of started off with like Mt. Gox, which was literally like formerly a marketplace for Magic the Gathering cards, right? So we kind of went full circle. But initially, a lot of Bitcoin was trading on Mt. Gox, and then Coinbase came around. They built a really consumer-friendly way to buy and sell Bitcoin. And then we progressively had more and more advanced infrastructure, right? We had BitMEX, Huobi, OKX, derivatives exchanges come out, I guess like the former FTX, and of course, Binance, all these exchanges started launching derivatives platforms. So you kind of saw over time that the infrastructure got more and more advanced. And as the infrastructure got more advanced, a lot of the trading volumes shifted from retail to these advanced players, and the entire space grew significantly as a result. So when we look at NFTs, effectively where we were before Blur launch, we were kind of in those, Mt. Gox Coinbase days where the existing marketplaces were very well suited for retail, right? They had this like traditional shopping experience. It was very easy, like consumer friendly UI. But the thing is, for the pro users, that is an increasingly large segment of the market. They didn't really have the tools they needed. There's a lot of data that you kind of need to effectively trade in the NFT market, seeing like the sales charts, like momentum charts and live activity feeds. A lot of the marketplaces, they didn't have real-time order books. It was kind of like a refresh-based system. So what Blur did is we built effectively kind of like a spot exchange, right? Like a real-time spot exchange for NFTs. So on Blur, you can trade NFTs in bulk very quickly. You can buy and sell very quickly. We surface a lot of information such as like the depth chart of the market and a live activity feed. Those are just a few of the features. It's kind of hard to name like any single one feature. It's more so that, we built this NFT marketplace for pro traders, and there's a number of different UI, UX, and also just like infrastructure considerations that kind of go into that.
Yeah, 100%. It's all about the holistic trading experience, right? Now, when you say pro trader, to some that might sound like a bit of a niche target group, but since you launched, you attracted tons of volume and you've really been able to maintain that well. So I'd love if you could maybe one, define what you mean by a pro trader, and then speak a bit about the main drivers behind the surge in volume that you saw right after launch.
There's no like any sort of specific like cutoff for a pro trader, but I think if you look at the different categories of buyers and sellers of NFTs in the market, of course you have like casuals, like maybe these are retail people who like buy their first NFT. They're dabblers, right? Like they kind of aren't super active in the market, but they bought like one or two. There are those people. There are collectors, and these are people who are typically buying assets. They have a very long view on the collection. They want to hold it for a long time. There's a lot of like art collectors. There's a lot of PFP collectors. They hold for long periods of time and they're not necessarily interested in selling on a short time frame. And then there are traders who they are kind of navigating the market. They might hold a position for a few months. They might hold it for a few days. They might hold it for a few hours. They're typically very active. They, on like a weekly or monthly or even daily basis, they're going to be placing trades. So it's hard to kind of give a specific cutoff, but there's these kinds of three categories of players in the market. And if you look at someone, you can kind of see pretty easily like whether they're like a trader or a collector or like a dabbler, like retail. And there's a far fewer traders than like these like more like retail cohorts, right? So if you look at Blur versus our competitors, primarily our number one competitor at this point is OpenSea. They have more daily active users using their marketplace, but the volume on Blur is higher because the volume from traders is just much greater than kind of like the retail segment. And if you look at pretty much like any sort of market in existence, you kind of see a similar pattern, right? So it's like in the financial market or even like in tokens, right? It might just be like, oh, 3 market makers make up 80% of the volume on exchanges. And then the remaining 20% is from the more casual, or maybe like it's like funds or like individual traders. So you kind of see this similar segmentation in the traditional like token markets. And similarly in NFTs, you're seeing that similar like behavior play out. It's just kind of how markets work. So that's why the volume on Blur has been so great. Even though we have less DAUs, those traders they trade in more size, right? They trade more frequently, so the volumes are going to be greater.
Got it. And on the topic of volumes, I'd love to hear a breakdown of Blur's economic model, as you are both an aggregator and a direct marketplace. And then, of course, in the more longer term, how your business model will build onto that.
Yeah, that's a great question. So a key component of Blur, when we were thinking about how to maximize the value of Blur to end users, one key component that is a key primitive that is available as a Web3 business is, of course, having a token be core to the functioning of the protocol. So similar to Uniswap and DYDX and GMX, Blur will have its own token. The majority of the token will be distributed to Blur's end users at the end of the day. And we see the token as an incredible way to effectively align incentives between the users and participants of the network and the network itself. So ultimately, the Blur token is going to be what controls how the protocol works and effectively makes money. When we think about the different ways in which the protocol can generate revenue, I would say, just stepping back a bit, our primary focus right now is effectively maximizing the value of Blur to end users. That's our number one goal. And we're not necessarily targeting basically revenue generation from a protocol's perspective in the short term. When we think about how the protocol can effectively monetize in the long term, there are various ways, but if you look at how marketplaces and exchanges have monetized in the past, that kind of gives you a pretty good clue on how Blur can monetize, right? So like the typical way that exchanges or marketplaces will monetize is they'll have like a take rate on trades. And that's like a very tried and true business model. It's been very resilient. There's basically been no marketplace or exchange that has, considerable market share or volume that hasn't been able to monetize in that way. So that's like a fairly basic way. But in terms of how that's specifically implemented, that's something that's going to be shared more once we publish our tokenomics later in January, which is when the token is planned to launch. If you look at the traditional like DEXs and DeFi, I think there's a lot of different angles in which this can play out, right? So there's like Uniswap, they have a a fee switch model. There's something like GMX where they kind of have like a revenue share model. Curve also has like a revenue share model. So there's various different ways that it can be played out, but ultimately it will be something that's controlled and governed by the protocol and the Blur token.
Yeah, definitely. It's all about volume for now, right?
Yeah, when we think about maximizing the value of Blur over the long term, ultimately, there's a lot of history that you can look at in terms of how network-based businesses are built. So if you look at, like, for example, Taobao, which was Alibaba's like eBay competitor. This was back in like the 2000s. They very famously launched with zero marketplace fees. And eBay, they were charging a fee, and Taobao didn't actually charge any sort of fees for the first like 3 years of their existence. They were really focused on the growth. And then I actually believe that the way that they monetize, it primarily wasn't even on like the transaction fees. I think they actually figured out like another route to monetization, because just once you create a network that's valuable, there are so many different ways that you can monetize. And the hard part for any network-based business is not really monetization. It's really just building the network in the first place. If you look at Facebook, right, they didn't really make revenue for like the first 5 years of their existence. There are numerous examples like this. So for us, when we think through, how do we maximize value here, it's really clear the hard part is not the monetization. The hard part is building the network, building the product that actually provides value to the end users over existing tools and solutions in the market. So that's what we're really focused on.
I love the way you're thinking about that. You mentioned the Blur token, so let's speak about that for a bit, because the airdrop has been spoken about a lot, and everyone is, of course, trying to game every airdrop out there. But you came out with this 3-part structure for your airdrop and are doing a lot of work to filter out users that are just purely trying to game it. Would be great to hear how the 3-part structure came to be, and if you could also just preface what your airdrop is all about.
Yeah, great question. So for context there, we launched Blur in late October, and we announced that there would be a Blur token airdrop for Blur's users. And the way it would work is that the first airdrop was for a retroactive airdrop, and it was an airdrop of care packages. And these care packages can effectively be open for Blur tokens once the token launches in January. And that was a retroactive airdrop because Blur did not exist before that point, right? There was no like Blur user to airdrop Blur to effectively. So it was retroactive. And then our second airdrop was for everyone to list on Blur. So everyone who listed on Blur actively from October 19th to December 5th, after meeting a certain threshold, they received an airdrop of care packages. And then finally, for our third airdrop, we launched bidding support. And our bidding product, we invested heavily into to make it really easy for people to place bids. It also came with gas list cancellations and stolen NFT protection, which basically just means that if someone buys like a flagged NFT that was like stolen, they're not able to sell it into your bid. So there's some protections around it. And basically our third airdrop was for everyone who's bidding on Blur. And to step back a bit, our number one rule when it comes to airdrops is to never incentivize volume. The issue with incentivizing volume is that as soon as you incentivize volume, you create a wash trading incentive. So this is what we saw with some other NFT marketplaces, prior NFT marketplaces that launched. They had token rewards directly tied to volume. And what that results in is you'll have arbitrageurs basically just do an EV calculation, and they'll say, okay, if there's this much, token reward for doing a trade, then I'll just wash trade up until this point, and I'll get, it's like a plus EV move to just wash trade. So this is something that you've seen happen in both NFT marketplace land and also even in DeFi land. There are exchanges that have done this, and it kind of pumps up your metrics, but everyone knows those are fake metrics. And also it really makes it difficult to build a great product, because you now don't know if you're doing well because people are actually using you, or you're doing well because there's 1,000 bots that are just wash trading. So the number one thing that we made sure to do was to never incentivize volume. We only ever incentivize liquidity. And so that's why for our second airdrop, the first airdrop basically that you could like actively work to gain, we only incentivized listings. And by placing a listing, you could basically like earn points in order to get like an airdrop. But having your listing bought by someone else didn't do anything for you. So there's no wash trading incentive for you to actually have your listing be bought. And then similarly for bids, we incentivize bids, and the bids that are closer to the floor price, so closer to the market price, they get more points effectively. So we're trying to incentivize good liquidity to come into the market. But again, you only receive points for having an outstanding bid if your bid gets taken taken, you stop earning points. So there's actually a disincentive to wash trade. So our number one goal was to basically incentivize liquidity and not volume. And this has led to Blur having very, very little wash trading. There is a great post by Hill Dobby, and he posted like a in-depth analysis of wash trading on different marketplaces. And Blur's marketplace had, I think it was like 92% of the volume he detected was legitimate, and only 8% was wash trading. And I think, like when it comes to wash trading, like there's always, even if we don't do anything, like basically people will try to like wash trade to like manipulate the market or something like that. Like that's something that you kind of see on any sort of like marketplace in existence. So there's like some activity, like that's the only explanation that I can come up with for why there would be like any sort of wash trading. But effectively, 92% of the volume is legitimate. And the reason why is because we've only ever incentivized liquidity and not trading specifically.
Yeah. And again, I really like how comprehensively you're approaching everything. Incentivizing liquidity over volume definitely seems like the way to go. We've seen many times over with marketplace launches that volume and users drop drastically as soon as token incentives are cut out. For example, here, if I pull up a few charts on Token Terminal, it looks pretty brutal. So if over 90% of your volume is actually sustainable and organic at the moment, then you got something pretty good going for you. Will be exciting to see how that plays out post token launch. But yeah, it definitely sounds like you've built a great product for users. But in the NFT space, that in itself is not enough because you also need to satisfy the needs and wants of creators. So I wanted to ask about your approach to creator royalties because that has been quite a polarizing topic.
Let me share some context on the history before Blur launched, and then what Blur launched with, and then what we're moving towards, because I think that entire context is kind of necessary in order to kind of understand some of the policies that we're working to support. So first, if for context on the creator royalties, right? So the royalty, just I'm not sure how familiar all the listeners are with the NFT space, but basically, when an NFT is sold, most marketplaces allow creators to set a royalty such that every NFT that's sold, some of that transaction value goes to the creator themselves. So it's like not even the marketplace, but like to the creator of the NFT. And this has been a very nice way to incentivize creators to come into the space because it allows the artists or creators or the teams, like a lot of the NFT projects now, they're full companies behind them, right? Like they've raised VC funding, they have a big team, and they push out for it. It allows them to kind of earn ongoing revenue from the asset that they create. And effectively, up until June of this year, pretty much every marketplace fully enforced creator royalties. It's not something that is enforceable at a smart contract level, so you can always circumvent it. You can, even in the most extreme case, it's like you can call up someone, send them your NFT, have them send you their ETH, and now you have like a trade, right? Like no matter like what smart contract limitation you have, as long as you can freely send NFTs, you can always do a royalty-free trade. So even though that was always the case, creator royalties were effectively fully enforced on the major marketplaces up until June. In July, a protocol called SudoSwap launched, and they basically launched and said, we're not actually going to support any sort of royalty. And because they had like a lower cost basis for each trade, started gaining a lot of traction, started gaining market share. In August, Gem, which was the leading NFT aggregator at the time, it's an aggregator similar to how like 1inch is a DEX aggregator. So Gem is an aggregator, and they're the leading one, and they're actually owned by OpenSea, and they integrated SudoSwap, and that really legitimized the protocol, gave it a lot more eyes. And what happened from there was it was quite obvious what was going to happen, and it was clear to us that at that point the kind of like dominoes would fall. And we saw it play out where 3 days after Gem integrated SudoSwap, X2Y2, which was another leading marketplace at the time, they announced that they would be moving to optional royalties, right? So they felt competitive pressure from SudoSwap being integrated into Gem. They directly cited that as their impetus for doing so, and they moved to optional royalties. And then over the next month and a half, basically, to 2 months, we saw X2Y2 and Sudo, gaining market share and volume. And when we launched Blur, what we realized was, okay, there's a certain segment of the market that's like very price sensitive and price efficient. So they will, seek out venues that give them the most efficient execution. And currently, those market participants are using X2Y2 and Sudo. So we launched Blur with incentivized royalties. And what that meant was, as a trader, you could list with 0 royalties, but you would get a much smaller airdrop than someone who listed with full royalties. And so we utilize our airdrop as effectively like a carrot to get traders to go, hey, okay, instead of doing a fully 0 royalty or using a 0 royalty protocol, why don't I at least honor some royalties? And the goal was to try to, increase the effective royalty rate across the board. And we saw that work to some extent, where the effective royalty on Blur was higher than on the other platforms, but it was still lower than OpenSea, which had a full royalty enforcement policy. So we saw it work to some extent. It didn't work to the full extent. And it was clear to us that changes needed to be made. We could have invested more heavily into the incentivized royalty mechanism, because one of the improvements that we could have made was, instead of having a vague, like, oh, zero royalty is a small reward and full royalty is a big reward, we could have assigned, what we've learned is that like being more explicit is useful, just because it's like hard, like how can you kind of think through something if it's not really fully explicit? So like we could have leaned more heavily on that, and we could have been even like, oh, if you do zero royalty, you get no reward. And if you do like 50% royalty, you get like, some reward, and 100% royalty, you get like 10x reward or something like that. We could have leaned into that. Something that we're doing instead is, and we're going to share a thread on this in the future, but effectively we're going to start enforcing a minimum royalty of 0.5% on collections that have a royalty set that's higher than that, of course. So we're going to enforce a minimum royalty. And this policy, just to clarify, is for existing collections that don't have the ability to filter zero royalty venues. So new collections, they can use something called a filter registry. That basically, one of the negatives of it is that it effectively reduces decentralization, and it kind of reduces ownership rights, but it allows the collection creators to filter which marketplaces the NFT can trade on. It's a circumventable filter, but it has worked. It's working in the meantime to kind of be effective. So for those collections that are able to filter the zero royalty venues, Blur enforces a full royalty on those collections. But for existing collections, like a lot of the blue chips, like, Azuki or Bored Apes or whatever, or collections that want to go fully into the decentralization route and give their holders full ownership rights, those collections don't have the ability to kind of enforce royalties or prevent those NFTs from being traded on pseudo, where there's no royalties enforced whatsoever. So when we think through the policy for them, basically what we're going to try to do is we're going to start with a minimum royalty of 0.5%. And then the goal is to observe how the market reacts to that and increase that royalty over time. We've kind of come up with a price matching policy that we think that can kind of like create like a game theory optimal outcome where royalties get more enforced across the board. It's kind of hard to go into detail on it in such a short podcast call. So I'm just going to pause there, because it's just like way too much of a rabbit hole.
Thank you for that quick history lesson. Sounds like you're on top of the royalty issue as well there. Now, going back to something we spoke about in the beginning, so lacking infrastructure in the NFT space, you said that there isn't really any single feature that the space is missing per se, but as you are pioneering all kinds of new tools and approaches, have you come across any specific parts of the NFT market that would like direly need improvement?
The general focus that we have at Blur is improving the liquidity of the market. What we saw in the token markets was that as the infrastructure improved and allowed, and as we saw things like options and like futures and margin and perps, like all these other sorts of derivatives and beyond, what those infrastructure improvements did was they allowed the market to grow, because you could have more liquidity come in, and more liquidity means that bigger players can come in size. Because like a big fund, like right now, it's not really possible to deploy a lot of capital into NFTs easily. There's just not that much liquidity across the board. And that ultimately restricts the growth of the entire market. When you look at NFTs compared to tokens, the token market is much, much larger, orders of magnitude larger than the NFT market. And that entire space has just been greater for every player across the board. The token market is much bigger. But when we think about NFTs and we think about like why NFTs haven't grown as much, it doesn't seem like the technology or the asset class as a whole needs to be held back, because NFTs have much broader appeal to consumers and to people than tokens do. Every big token boom was driven by, like basically like tokens going viral in like the normal, like normie land, right? Like you have like Dogecoin going viral, you have like Ethereum going viral. So you have all these like boom cycles that really expand the entire space. And when we think about NFTs are just like way more culturally in tune with people than something abstract like a token. So the ceiling for NFTs from our viewpoint is that it's much, much higher. But because of the liquidity challenges, it means that you can't really have people come into the space. It's like when Bored Apes are like $100,000, that's not the case right now, but like when a Bored Ape is like $100,000 and there's 10,000 of them, it's quite difficult for like any person to participate and buy any aspect of like a Bored Ape. But for like Ethereum, when Ethereum's at $4,000, you can still buy $100 of Ethereum, whether it's at $4,000 or like $1,000. Obviously, there have been attempts at solving this with like fractionalization. There's a lot of issues with this. One of the challenges of NFTs is that they are a different kind of asset. There are fungible aspects of it and non-fungible aspects of it. So you can't just treat it like tokens. We've seen a lot of traditional token exchanges try to launch NFT products and marketplaces, and none of them have taken off. And that's just because the asset is fundamentally different than tokens. And so you can build things that are similar in spirit, but ultimately it has to be specifically designed for the NFT market. So when we think about how to grow the NFT market, we're thinking through, okay, how can we build infrastructure that unlocks liquidity for the market in a way that makes sense for the NFT market? And it doesn't mean just making like NFT perps or something like that. Like you can't really just do things like one-to-one. Because the market is so different. But there are a lot of lessons that you can take from the traditional token market that can be applied to the NFT market that can increase the liquidity, allow larger players and more players to come in and participate in the ecosystem, which ultimately will allow the space to grow and reach its full height to match the cultural dominance of NFTs.
Definitely. And you did launch Blur Bids to start tackling that problem, which to my understanding reached tens of millions in TVL pretty much right away.
Right. And that was like even that's like a very basic thing, right? Like that's just like a normal exchange order book. And what we did was make it very easy to place and manage bids, because most of the marketplaces were very focused on the listing side. But it's like, it'd be like if Binance just had an ask order book and no bids, and the volume would just be so much lower. So yeah, we just focused on that. And that last time I checked was at 30 million TVL now, which is like probably not the biggest for like a centralized exchange, but for like NFTs, that's a really massive amount. So yeah, it's even just like basic things like that.
Yeah, sure. I guess that really speaks to the fact of how early we are in terms of the tools in this space, that these somewhat basic improvements have such a big positive effect on things. But yeah, so I'm going to hit you with one last question, and that is, what's next for Blur? What are the biggest milestones on your mid to long term roadmap?
There's a few things that we're working on that like we can't quite share. I think what I can share is the general direction that we're looking at. One is we have our token launch coming up. It's really important for us to maximally use the primitive that is like a token. So when we kind of observe how tokens have been used in DeFi, there are some protocols where it's like the token is very well integrated into the functioning of the protocol, and other ones where it's kind of just like slapped on, it's used for governance, but it's like not really used for anything beyond that. And we definitely lean more towards, the token is an incredible primitive. Let's make full native use of the token. It's kind of similar to how, like the iPhone first came out and like apps were becoming a thing. It was very difficult for traditional companies to go and make an app. Like a lot of them would just make like an app that was like a wrapper around their website. And none of those ever really succeeded. It was only when, the native app companies built apps that were fully maximizing the technology that they were built upon that you really saw like the breakout successes. And so for Blur, our big next focus is really the launch of the token, integrating that into the marketplace in a way that actually makes sense and is really just like fully using that primitive. So that's our number one priority. Our next priorities are, like some of the future features and product launches can't quite share yet, but I can share they're generally focused around the theme of improving liquidity in the market, because that's what we believe will allow the entire space to grow much larger. So, in short, the token launch and improving liquidity.
That sounds great. I can't wait to see how everything plays out. Thank you so much, Pacman, for this great overview of Blur and the NFT market in general. This was super insightful, and you have so many exciting things coming up that let's make sure to do this again in a few months' time to catch up.
I'd love to. Thank you for having me.